Testing. 1 million, 2 million, 3 million. It works. So thank you everybody for coming here today. As you already know that we had some technical issues. It's always when there's two events after each other, there's some difficulties coming up, but no worries. We planned a little intro to this event and we skipped that. So we're actually on time. And sorry, Dennis prepared something for us today. He's not going to have an opportunity to present it. But still, the main thing today was the panel discussion about peer-to-peer lending. That's still going to take place. All the people are here. But before we go to that, I would like to take some time to introduce one technical widget we're using today. It's slido.com. Everybody who has a mobile phone or a laptop, go to a web browser, type in slido.com, and there's a place where you can put the event name. This is going to be the P2P, and you're going to be taken to this screen. You can vote for the poll here. So the question right now is, which peer-to-peer lending marketplace are you investing in? Remember, you can select multiple options. So just for you to get to know the app well. Also, what we can do with this is we can ask questions. So whenever you have a question in the crowd, so you can go there. There's a designated place for questions. Ask your question. Other people can vote for your questions. And actually, I'm going to show you an example of this. As it should bring up pretty soon. Or maybe not, so I'll go on. So this is for asking questions. Actually, you can vote for questions. There's a thumbs up on the right side, so now you can see it. If you can see this question on your mobile phone, put thumbs up for this question. How you're feeling today? Really good. Right now, 2 people have gotten into this stage. And of course, we're going to take questions from the crowd. We have an extra mic for that. So whenever you have a question, just raise your hands up. I think Dennis will look out for your questions. If we can't see them, then just yell or do some weird noise. But let's get to the main part. So panel discussion about peer-to-peer lending today. I think this panel has never been here in Estonia together. I think I'm not mistaken here. So we got really wonderful guests from Latvia. And I would like to actually ask them to come here one by one. So first, Martins, please come ahead. Martin from Mintos. And take a seat to choose your... the founder and CEO of Mintos, which was launched in 2015. Next up, second Latvian today here. Really nice to put your hands together for Jevgenijs. I'm going to say choose your seat, but I think the seats are already allocated. So take your place. Third up, Daniel from MoneyZen. Thank you for being here. That's good. But we're going to go on. We have 2 more guests here. First, then I'm going to take... it's good. Closer to me. So, Kristi Saare, an investor, a blogger, and also founder of Women's Investment Club in Estonia. So, welcome. When there's a woman in the crowd, you always have to get the hug. I went with that. So, and the last panelist we have today is Pärtel Tomberg from Bondora. Welcome, please. And you have to get the hug from a man too. Dennis, I'm going to give you the second mic. So whenever there's a question from the crowd, you can go ahead and ask, and give the mic to them. They can ask. So the first question, it seems it's gotten so many votes here, so that I would like to go off to that. So how are you feeling? Are you feeling good? let's start from Daniel there.
Good right. Good right.
Good, right. And let's go on. Let's. I would like to.
I'm feeling great.
Right.
Yes, good as well.
After the harm.
I'm at the 19th.
Okay, you're the 19th. So really good. As we go on, actually, I would like to introduce. I would like to start this panel from more general questions. So, sharing economy as such is we have a couple of really big players in the market. There's Airbnb, there's Uber. What do you think of sharing economy as a whole, and where does the crowdfunding fit into that? How does the crowdfunding fit into the industry? Let's start from here.
Yeah, I guess there's been a lot of discussion also about whenever you do all these buzzwords, crowdfunding and everything, is a lot about how you define. And I guess, actually, especially when you talk about the well-known companies as Ubers and Airbnbs, it's actually sort of a misnomer to say sharing economy. The better coined term is access economy, because you see more and more platforms actually adding a lot of value in between. It's not really that the consumer and the service provider are connecting directly. And this is what I see also in the crowdfunding and in the peer-to-peer lending as well, that actually the platforms in between are providing quite a bit of value in this service. It's not, we see less and less of the direct relationship between the lenders or investors and the borrowers. Yeah.
Pärtel, what's your experience with the sharing economy and then crowdfunding as such before Bondora?
I don't do a trip to a hotel. I haven't done so like in the last 5, 6, 7 years. I don't drive cabs, so I've always switched over. Before Bondora, however, the picture was completely different. Not that Bondora changed all of this, we didn't create Airbnb, but there's a huge shift towards, let's say, sharing economy or whatever you call it. The main thing is, bricks and mortar businesses that used to have big branches or big branch networks or shop networks or skyscrapers in the city are just being replaced by more nimble competitors or tech-driven companies. Now, are they sharing based or they just hype? Effectively, it doesn't matter, because what it's doing is making the services, in our case, lending and investment, cheaper and more accessible to more customers. So, are you doing it by sharing stuff, or are you doing it by better use of technology? It doesn't matter. But what I've seen is more people are investing today than maybe 10 years ago. More people are driving cabs because of the setup. And more people are able to travel into cool places because of things like Airbnb. So the access is going wider and it's getting more and more unaffordable. And I think we're going to see this trend go more and more through other aspects of financials. I mean, we're all operating in a pretty easy to understand part of financial services. And we're going to see this move more into the SMEs and corporates over the next coming 10 years or so.
Kristi,
Yeah, the access is
I
the
would
big word.
actually like to ask from the investor side, which value to see in crowdfunding and peer-to-peer?
Well, I'll still go with the word access, that I am getting access to different investment methods that 5, 7 years ago would not have been accessible due to the minimum capital amount that you have to have. That the idea of starting to give out loans the way you can do it right now was just not possible. So this is the main value, that if sharing economy did not exist, then I think a lot of the investors, such as myself, would not exist either.
Let's go on.
Yeah, so sharing economy, whatever you take it to, Uber, Airbnb, or P2P lending, is about efficiency. Right? Efficiency that was made possible because of the technology. If you think of Uber, right, we always had operators, right, but it's pretty inefficient and costly way to get a cab. You call someone, so you have to hire people to answer the calls. Then you have the operators that have to communicate with the cab drivers. So essentially everybody loses, right? The cab drivers get less, it costs more to the consumer. So with the technology, right, it just you can automate, 90% probably of this process and spread the benefit, right? So part of it would go to cab drivers, part of that would go to the riders of the Uber cars. Same happens with the peer lending. Before peer lending, we had the inefficient organizations in the form of banks, right? And what peer lending does, it doesn't invent the industry. It's still lending. It's still investment, which used to be deposit. We're just like way more efficient on both sides, and then sharing some of the benefits of this efficiency with both sides.
Daniel.
I agree with all what is said. For me, it's also the same. It's efficiency for development in technology, and it gives people more information, simpler choices, and better opportunities for everyone.
So actually, as apparently you can hear, everybody's seeing what crowdfunding and sharing economy does. So why did you decide to found a platform or site where people can invest on? And the second part of the question, where did the idea come from?
The idea came from the experience or knowledge what is on the market and the understanding it can be done differently and a bit better. But why did I make a choice to start this? Is just to give another opportunity to present an experience and possibility for a user of MoneyZen.
Jevgenijs.
I'm grateful to my entry into P2P lending to Pärtel. Back in the day, hired me to Bondora. But after I entered the industry, I realized how big is the industry and how much inefficiencies there are. Wherever you touch a bank, any service, you feel the inefficiency. 3 people processing 1 payment in a branch. People manually processing loan applications. 4 people doing IML on a depositor. So once I was in the industry, I realized that it's just enormous industry, and it will take probably 50, 100 years to change. So there'll be a lot of things for me to do in this industry. That's why I'm so excited.
And go on with Pärtel, but it's not the why question, but how did you start Bondora? What did you need for that? Did you need capital? Was the people? What were the first steps?
We started in 2007, end of 2007. Actually, it's a really long story. You want that? Maybe we can sort of shorten it, because let's say the short version is that when we started, that was a century ago. That was almost 10 years ago, right? So I think it was 2007. We kicked off. We launched in 2009, and then all the rest of the fellows here have come on over the last couple of years, and there was a big gap in between. When we kicked off, then there was a couple of things happening. It was credit crunch, which caused a personal reason for me to go into B2B lending. Was that prior to that, I was sort of holding a position in investment bank in London. But after the credit crunch came in, then basically, all positions in investment banks in London and elsewhere were gone. And bank lending was away. Even good customers didn't get loans anymore. So the previous credit crunch just created this enormous opportunity for us to go into. And as we kicked off in Estonia and we built everything, on top of the Estonian infrastructure, it did not require a lot of capital. And that was one of the reasons we kicked off, sort of, moving into it. It seemed as if the biggest opportunity in history to, go into banking or, effectively found a banking entity or financial services provider with, much less sort of red tape and bureaucracy and capital that had ever needed before. So it took us around 18 months of a long story to get to 2009 in February. But I think it was really about the people and the opportunity that type of time.
Martins, for you, how did you start?
Sure. So actually, my first exposure was back in the day when I was looking for a loan for my MBA studies. So I'm actually a borrower on one of the platforms called Prodigy. So they connect international students with alumni. So I took a loan from them, which was back in 2012. Then after studies, which was 2014, the peer-to-peer lending space was progressing, and it seemed just the right opportunity to take and basically to develop it further. So what we do, we build one marketplace for loan originators to use us. So the loan originators actually do not have to build themselves platforms. Instead, they come to Mintos and they can concentrate on what they do best, it's originating the loans.
And you told that the process was pretty fast, so it only took 8 months from the idea to the product.
Hours-wise, probably it wasn't that fast. So we spent a lot of time during the development phase. Basically, we came up with the April 2014. We established a company in May 2014, and then we launched the first product in January 2015. So it took us 6 months approximately.
And also, there's a comment on the screen. So cheers, Mintos buyback guarantee.
Where I have to say that the buyback guarantee is provided by the loan originators and not Mintos.
So yeah, but nay. But let's go on from here. So I would like to talk about the product itself. So there's similar products out there. So banks are offering loans. There are credit offers. When comparing peer-to-peer lending with these offers, how does it differ, Daniel?
I think it's again about more choices for lenders. If we look at the lender side, and if there is more opportunities on the market, then the lender can make a choice which suits him better. And same thing is for an investor. More opportunities he has, the better are chances to find what suits him or her. And that's what is crowd or shared economy is about, more choices.
Jevgenijs, do you agree, or do you have any other additions to this?
I think, it's too early probably to talk about benefit for the borrower in continental Europe. Because the end benefit is clear, right? As I said, through efficiency you can become cheaper to both sides, right? So investors earn higher returns than on deposits, and borrowers can pay less on the loans. But this still requires skill. Right? So if you look at the US or the UK, only recently they got to the point where they can actually compete with the banks on the rate, and this is a kind of a natural evolution as I see it, right? You maybe start with the unbankable clients, and then maybe with the higher rate, that kind of where speed matters, but you work every day towards the end goal and essentially becoming more efficient than the banks. I mean, offering lower rates, but it will take time, and as we saw in the US and the UK, to 4 to 5 years of growth.
Martins, Pärtel, do you have anything to add?
I don't entirely agree with Jevgenijs. Bondora is the third largest consumer lender in Estonia, including the banks. It's the first of non-bank lenders. Of course, we've been around for a few years. There's a 3 clear benefits, but these are what people have to kind of understand is that peer-to-peer lending isn't a benefit for the consumer. This is something actually, the whole concept about crowdfunding, peer-to-peer lending has a much bigger effect on investors rather than consumers. For a consumer, what matters is getting the loan they want at an affordable rate and fast, right? Now, banks, other than a very few banks who are doing this to their own customers, are not able to provide these services, both to people who are not the bank customers today, and especially the people who aren't the bank's customers today. So, and why we've seen peer-to-peer lenders, marketplace lenders grow is that prior to this segment, we had beta lenders, and then we had banks, right? And the whole sort of, there was a huge chasm in between. So you had either like ultra prime customers, and then let's say a bit sort of, riskier ones and other spectrum. And the whole spectrum in between that used to be occupied by the banks as well have been left open. One is driven by regulation, other is driven by cost of doing this, and other number of things. And beta lenders cannot provide loans in this segment because their capital their balance sheets are tiny, and they are, highly, and the cost of capital is extremely high and very short term. So they have to revolve the capital around very fast at really high rates in order to make money. So you needed a different mechanism that didn't require deposit taking to fund like mid-term loans over a longer period. So on Bondora, the average term today is around 40 months. So it needs, your capital needs to be long term. And with balance sheet lending today in Europe is really, really hard to do that. And that's been sort of, I think, the biggest benefit and why we've seen ourselves grow here and now in other markets is there's a huge gap on the market that's been left open by the banks, and marketplace lending is one of very few options to actually fund this gap today. This will change over time. In UK it's different, in US it's different, because there's much more capital opportunities for companies. And in Europe, there's not really any major alternatives for companies to get capital enough to tackle this segment.
Jevgenijs, do you want to comment on that, or do you agree with Pärtel in that sense? A little debate maybe going on.
The Pärtel's right about balance sheet lending. The source of capital changes what type of loans you can originate, right? And we started as a balance sheet lender back in 2009, right? And we launched investment platform just a year ago. And this is why kind of investment platform is essentially a game changer for us, right? Because we started, in payday lending business, we moved to installment loans as a group. But what the investment platform Twino does, it helps us to actually tap into the prime segment, which, as Pärtel mentioned, isn't possible for balance sheet lenders, right? Because capital is short term, capital is pretty expensive, given the way you kind of repay back. So this kind of the P2P element actually helps us get into the prime segment as a balance sheet lender.
I would like to actually move on with a little promotion round. So all of you are here, and there's so many investors probably in the crowd. So Martins, for you first for you, why invest in Mintos and not on others?
First of all, definitely diversification. So as part of the one marketplace on Mintos, you can actually invest in 10 different loan originators from 6 different countries, providing 5 different loan types. It's basically the best diversification you can get, and the diversification is the most important when you invest, when you minimize the risk.
Pärtel, I would go with you next.
Bondora has 6 years of track record. Competitors a bit less of. We're the only platform that has gone through 2 recessions. So we have experienced what's going to happen and how to deal with portfolios when things aren't going as well as they are. And third, over the 6 periods or 6 years, regardless the way you want to calculate the returns, they're still higher than any other platform or in comparable asset classes. So I think it's the track record, recession-proven, and performance that people should look for Bondora as part of their portfolios.
Jevgenijs.
Yeah, so we have a track record of similar to Bondora. So we launched in January 2009, as I said, as a balance sheet lender. And this experience essentially helps us bring lots of traditional credit risk management practices into Mintos, or into Twino as a platform.
You working together now?
If you think of it, so we're operating across 7 markets. We have around 330 people working within the group. So we have our own debt collection department, we have our own risk management department, and so on. So it's the kind of the traditional approach of someone who's been lending their own money and has been lending it profitably for a number of years. This is what we bring to the table for investors.
Daniel.
MoneyZen is a smallest at the moment of peer-to-peer lending companies for consumer lending, and why to use MoneyZen is just another experience for investor. It's automatic. It's very small time cost for setting up an investment terms and stabilizing revenue from prime lenders.
Jevgenijs and Martins, you didn't mention buyback guarantee in the pitch, so is that the thing you want to promote as you invite investors or not?
So when you think of the buyback guarantee, which basically we introduced first with a MOGO, is at the end of the day, when you look at the buyback guarantee, what it is actually the same as provision contingency or whatever fund you call in the UK, because it's the buyback guarantee is still managed by the loan originators from the interest rate spread. And how we look at this, the buyback guarantee, especially for small retail investors, it's basically the loan originators providing a very well diversified return. So as a loan originator, because they have the whole loan portfolio, they basically have the full diversification. When they provide the buyback guarantee, buying back the loans which go delinquent for more than 60 days, they basically say, okay, we give to the investors the same return which would be if they would invest across the whole portfolio. So as a small investor which is investing like, I don't know, 50 euros, 100 euros, even 1,000 euros, the investor receives a much better diversified return. So it's definitely one of the, especially for smaller retail investors, it's one of the advantages also investing through Mintos.
Jevgenijs, the same question for you.
Yeah, I mean, it's essentially for a retail investor or an investor who's just starting out, buyback guarantee is obviously a great thing because it essentially simplifies the whole process. You don't have to spend hours and hours analyzing the performance of the loans, what are the default rates and so on, right? You can invest into the loans, and if it's delinquent for 30 days, in our case, we'll buy it out from you and pay the interest. But if you think underneath, right, it's, I mean, every loan portfolio has a default risk. It's just a question who prices it. Us, because we guarantee the buyback, or it's the investor when they take default risk on their side. So it's essentially about the pricing. And recently we've been told quite by many people, you know, give us 15% return and keep your buyback. So there are a number of investors already in the space, including retail investors, right, that understand how to analyze the risk, how to analyze performance of loans, that they are willing to actually take the default risk for a higher return.
Kristi, would you go for buyback loans or would you go with ordinary loans on the market? Which is most important to you?
There are certain benefits to both, but if you are in Estonia a retail investor who does not invest through a company, then just for the tax efficiency, you should probably prefer the buyback loans because you cannot discount any default. If you are investing through a company, then it probably doesn't matter. It depends on your risk tolerance because if there is no buyback, then the return rate will probably be a bit higher.
What do you see the biggest difference, or how to even differ all of the providers out there right now? So they all pitch themselves, why should they invest in one or another, but where's the difference for you?
Well, for a small investor, you shouldn't probably only pick one. I have portfolios in all the four portals represented here right now, but they all have their own benefits. If you want to invest short-term, long-term, which countries do you want to bet on more, and how much work do you want to do yourself, or how passive you want to be. So there's something for every kind of investor portfolio, essentially.
So I would continue asking you, what do you think makes a trustworthy or a good peer-to-peer lending company? Is it maybe 4 pillars? Is it return? Is it the trust of the founders? Is it the security that the portal runs really good, or is it the deal flow?
I think number one is definitely trust, because I remember when I first found out about a thing called P2P lending when Bondora wasn't even isepankur then, they were sõbramäe, and there was no information. It was just like some suspicious website that you just transfer your money to, and it was just like, well, you might get it back, you might not get it back. So nowadays you have information and you know that people have actually gotten money back. When I visited the forum the first time, then people were like, no, everything's terrible. And I was like, okay, so that's a bad idea, and I returned like a year later. So the trust and the transparency, that you get information, who is doing what, that you see these people face to face and you can read their financial reports and all of this, I think, is definitely number one. And then the deal flow and the returns come afterwards.
Any of you want to comment on this? So what do you think is the... I know most of you invest yourself in portals, right? So what's most important to you?
I think trust is something when you get started, where there's risk and reward, or let's say there's greed and fear, right? When you get started and you're planning to send 100 euros or 50 euros somewhere, then there's very little reward. In essence, in absolute terms, let's say you're going to make 10% a year, which is way more than you're going to make in any other channels. But so you can gain 5 euro less than you send 50 euro to some guys in Lithuania and they run, right? So there's a lot of there's kind of they're not in balance. So I think that when people get started, the trust element is huge. Over time, the profiles change. So there are some people who are in for the long term or in for the returns, and who are in for really looking at the financials and just getting maximum out of it. And there's other aspects who want more trust and want the community effect. There's a lot of people who kick started sort of investing in P2P lending because of the community effect. And and I think we ourselves heard a lot of feedback on that the community setup is gone, the forums, all this, let's say somewhat the hype or the infrastructure that was built up in the first years, where there was a lot of talk about the community and all these elements around. However, most investors, like most people investing money, do not want to think and hear and read about money and investing, period. Right? I only invest on Bondora, but I don't want to I don't want to read and think about finances. I have other stuff to do. I have my family, I have my work about Bondora, and I think that sort of covers most of the 85% of the people. So, and there it really is about either the returns or trust, or just making sure things are moving. Because if you're investing 5% to 10% of your portfolio, that should be kind of max, just kind of to give you an idea. So if you have 1,000 euros to invest, and putting more than 50 to 100 euros on a single asset is kind of a bad idea, typically. If you diversify your investments around different options like that, then first of all, if you spend a lot of time on these elements, none of them are going to make a profit. Because if you put your time that you could use elsewhere into this, then they're not going to make a lot of eventually returns are not there. And secondly, you can be less concerned about specific elements or a specific return in 1 month. So whatever fund you put 5% into, if it has a bad month, right, you don't have to exit and run to the doors. If you put 100% into this setup, you have to be really, really concerned, and you're going to be more volatile. So I think for I as an investor, I have put 100% of my wealth into Bondora, but outside, just don't actively manage anything. Whatever stocks you pick, you're going to lose. If you put all your wealth into LHV stock, you're going to lose. It's never going to work, because you're always likely going to time the market wrong, either when you're entering the market or when you're exiting. So you should really sort of think about B2B or the individual platforms as small parts of the portfolio, and take somewhat of a passive approach there, because it's highly unlikely that it's possible to outsmart the market or beat the returns if you calculate your cost of time into this. You can do all of these things, but if you put your, how much your time with your family or your friends cost or at work, you can actually lose out a lot. And I think that's one of the things we're seeing in statistics, but we're hearing a lot, but about people speak about managing portfolios. But the main thing I think is that you can trust the systems enough that you can go passively, and B, that you diversify enough so you can go passively. Because an active approach will lose you money with the pension funds or in other cases.
So usually we can't give out investment advice, so I hope people here didn't...
That was a disclaimer coming from my lawyers.
Yeah, so people don't say that don't invest in LHV all your money.
I didn't say that.
Yeah, that's
I didn't say that.
But for others, I would give out the free mic. So the same question, what's most important for you as an investor, or what do you think investors are want to see in a site?
Yes, yeah, I mean, like if you look at the returns, right? So UK, 4.5%, Germany 6, 7, and then Baltic platforms, you have to go double digit. But there is kind of no hardcore data that would support that. Baltic platform is double the risk of a UK platform. So because the industry is so young, and there is kind of so little track record, there is, I believe, a huge spread in the rates, and it's purely subjective. So people apparently trust, UK loans originated by Vaba more than Georgian loans originated by Twino, and that reflects in the interest rate. And I think over time, it's just like as we build the track record, it should somehow, at least come close to meaningful terms. How really the underlying asset differs. More data-driven decisions than just the trust or subjective perception of the risk.
Thank you. Daniel, Martins, do you want to share?
From my perspective, the first thing to start with investments is to understand that you have to diversify. You're not going to win putting your eggs into one basket. So this is one principle. Now, then you have to check for opportunities, and when you have mapped them, then of course at first time there comes some analysis: who to trust, who not to trust, what stock to buy, what stock not to buy. But the good thing is that you have people around you, and for example, with investment club where you have a lot of people, you can exchange the information and experience about what has one member invested in and what another, and this also creates some good feeling about how to move and what to do and what strategy to pick with investment. So I think that trust is actually built on two pillars. One is the platform or company or stock performance. And it includes not only how it communicates to customers, but also the management, how the management is presenting the company, how management, what experience management has, and also the customer, let's say, communication with simple services like something is not working, how the company is resolving it, how fast and how comfortable for a customer the service is. So from that perspective comes experience, and then it goes to all the users of peer-to-peer platforms. And this is also the basis for decision either to trust or not to trust. But in a long term, in a long run, it's track record what is actually most important. If a company has been around for 20 years, stable performance, stable return rates, then most probably majority of investors would put some part of their assets into that platform.
Martins, do you want to add to top?
Well, I guess nothing new. It's probably transparency. At the end of the day, it's how you present information to investors, how you communicate with them, and how transparent you are about the operations. And that's probably how you build the trust.
So maybe it's good to go on from here. So transparency. Some sites give more out to investors, some more information about borrowers, and some don't. So how much information do you give out, and how much transparency do you have in
So here again, it's gonna differ. So as a marketplace, the transparency gonna differ by the loan originator. So we have 10 different loan originators. Some of them gonna give out more information, some of them gonna provide less information. But we have certain requirements, like for instance, we are publishing all the annual reports of the loan originators. We are running the investor webinars with investors, talking about what's happening with the marketplace. For some of the loan originators, then they're gonna provide actually a lot of information. Like for business loans, it's still not like where we want it to be, especially when you look from the data perspective, how you can deal with this data. But the data is there. Like for business loans, you're gonna have the full like 3-year financials for most of the business loans. You're gonna have the descriptions, companies, and all this stuff. So it's gonna, for us, it's especially since we do not originate any loans, we are very dependent on what the loan originators can and want to provide.
Maybe I would like to go on from here. That's about the deal flow and the investors. So how important is deal flow, and how important is the number of investors, and where is the good balance between them in a portal? Daniel, would you take it away?
Both are important, but if we ask it from another perspective, then if there is no deal flow, then eventually there will be no investors in the house, because what are they going to do with the money just sticking around? So the number one priority is that you have deal flow coming in, and there is also a challenge to fix or to match it with investors' money or who will finance it. But the top priority is to bring in sufficient amount of deals.
Jevgenijs.
Yeah, I think this is the most critical part of P2P lending, and I believe this is why continental Europe is so much behind. There is some sort of magical ceiling of 1.5 million euro per month in origination that so many new platforms started and then hit the ceiling and just couldn't get over. I mean, lending is extremely difficult business, right? So you just cannot throw marketing money at it and expect it to grow tenfold, right? It just doesn't work like that. And this is why I believe many startups who started from scratch, they hit the ceiling. If you look at the largest players, they still originate, 15 million euro per month? So it's like pretty much nothing. So at the end of the day, this is why probably, the P2P in continental Europe hardly took off. So for us, the benefit was that we were a balance sheet lender. So currently we originate 15 million euro per month already. So we can provide enough liquidity for the investors, right? Even with our monthly growth. But we're already thinking ahead. Okay, so 15 million euros is not the end all, right? How do you get to the levels of Zopus and rate sales, which is like a billion probably euro per year? So that's a different kind of game, and I doubt there are many players in Europe that can hit it. And this means that, at some point everybody will hit the ceiling.
Kristi, how important is deal flow for you? Why is the party stopper?
It's definitely very important, because once you pick a portal and you invest some initial amount, then you want to keep adding money every month, and you want to reinvest the money that comes in, and you don't want to be in the situation where you're sitting there and going like, oh, there aren't really enough loans, and now I have to think what to do, if I have to take my money out and put it somewhere else or not. So you kind of expect there to be this reasonable month-to-month organic growth, that you don't need to keep altering your strategy just to be able to divide up your money between the different loans.
Pärtel.
I think, as spoken earlier, without loans to invest in, there's nothing to invest in. So it's effectively very obvious. I think it's more nuanced question is what kind of deal flow, because I think anyone in this room would, quickly make a loan business and have 100 million of applications coming. The question is, are you going to get the money back? And also the question is, what's the preference of the investors? Because if you just, try to explain the world in very simple thoughts, then there's a lot of capital that wants zero risk at high returns. Right? I mean, kind of everyone in this room wants zero risk, high returns. And then there's a lot of, borrowers on one end who want, are zero risk and don't, want to provide any interest, or who want to provide returns and are happy paying returns, but they're high risk. And there's a sort of continuous sort of, shift in the risk preference of the investors and the actualities of the life. And what we've seen ourselves over the years is that even if there's deal flow discussion, it's also what kind of deal flow. So if an investor prefers A, B, C loans or, or something else, then, getting all of these things might be that everyone wants this. So, everyone wants Apple stock and it's booming. So I think it's extremely important, and it's for a platform's perspective, especially if you originate and distribute, on one platform, not that you have multiple things on your site, then it's the hardest thing to manage. Similar to MoneyZen, we've taken the approach over the past 2 years to focus on getting a very well thought out origination and servicing product ready. To be able to access borrowers in volume and able to service these portfolios over the years. Because this takes a lot of time, a lot of testing, a lot of sort of fine tuning. And only now we're, since end of last year, been focused on scaling up the investor product and the investor sort of marketing. And we're gonna, from 2016, our focus is going to be on the investors and the investor product. And that's because you can't manage both at the same time. It is almost impossible. Unless you have the setup where you already, like Mintos, who has an investment product and doesn't have a loan product, and Twino has also an investment product, doesn't have a loan product, but the parent company has this loan product. So in these circumstances, it's easier to do because for these lenders, peer-to-peer lending or the capital coming from this way is one source of capital. They have bank loans, they have like equity from the shareholders, etc. So it's one revenue source. From pure marketplaces, pure platform basis, it's very, very difficult. Because either way you build it, you're going to lose, let's say, lose face or lose trust. If you're going to have a lot of capital sitting on your accounts, then the moment investors who, figured out, yes, I'm going to try out Bondora, I'm going to try out, X, and put the money in, and then have to pull the money out because there wasn't enough sort of opportunities, it's really, really hard for them to get back in. The moment investors leave and put their money somewhere else, it's going to be extremely difficult to sort of get this capital back because it's deployed somewhere else.
Daniel, what do you think? So the deal flow hasn't been there all the time in MoneyZen?
No, the question of MoneyZen is concentration on a prime borrower. So it means that MoneyZen is picking the cherries, and it's more in competition with banks when compared to, for example, Bondora, who serves a very, let's say, very wide list of borrowers. So the problem is actually the strategy of the company. If MoneyZen would use a similar strategy as competitors, then the volumes would be much higher.
But there is enough volume in the prime segment. I think, if you look at the market, then prime segment is actually way bigger than the subprime segment. Right? I mean, if you look at the balance sheets of the bank, only credit card debt is enormous. If you think of all the payday lending effect, it's a small niche. Look at the largest player in Europe; they originate $1 billion a year. I mean, banks have like what, $1 trillion in unsecured debt or something. So I think the prime segment is actually way bigger, and that's a challenge. How to tap into that efficiently. I mean, obviously investors would require prime rates, but how do you persuade the borrowers, to borrow from you and not from the bank? So I think the prime segment, right, or what we we would call nowadays bankable segment, is the future of peer-to-peer lending in Europe, because it has the biggest potential. This is how we can create the lending clubs and Zapas of continental Europe.
Actually, I would like to move to the screen there, but before going there, I think one entry topic is going to be the scoring models and how you choose loans, what to sell to investors. So each of you have, or at least Bondora and MoneyZen has really good scoring models set up. So do you want to speak a little bit about the scoring model, and are you trusting the scoring model yourself?
I invest in Bondora purely passively, so I only, my sort of strategy is balanced across the board. In terms of the scoring models, then scoring models have taken us a lot of time to build, but we only actually switched to score-based or risk-based scoring in 2015. Prior to 2015, the ones who remember or used Bondora, we just made a lot of information available to investors, and you were able to sort of pick filters and have automated investments based on your filters. Because in order to build a scoring model that actually is reliable and that statistically makes sense, you have to have a lot of data points. So whoever starts out and has a scoring model, it's going to be wrong, one way or another. So it's taken us a lot of years to fine-tune and improve, and today there's so many different data points going in there already, but it's an ongoing process. The more data we're able to collect, the more data we can access, the better we're sort of making it. And it's going to be a process that renews itself at least every 6 to 12 months. And then we're looking to really compete on that, because like in earlier part said, the question is the real complexity lending is trying to pick the good customers out of the risky ones, and how to separate the good borrowers from the bad borrowers. And the definition of good can very sort of varies, but it's really, really complex, and you need a lot of data to do that. And we have a team of roughly like 10 people today who's purely working on the data, the underwriting, technology, and the sort of the scoring models. And plus we have over 10 more people who are actually doing all kinds of different verifications that work on top of scoring. Because scoring is one part of the underwriting. So one part is collecting the data from different sources, it's verifying the data and documents, and finally all of this data is fed into the scoring model that determines the expected risk level and price of the customer. So all of these are equally important, and all of these parts are actually what make the difference eventually, and what you have to sort of develop in order to compete with the banks.
Kristi, what do you think of Bondora's scoring model? To use it yourself to invest in the auto investment tool?
I think once you've decided to trust the portal, you have to fundamentally trust the credit model as well. Because as a retail investor, there isn't really any way for you to test or verify how exactly the model works, because as Pärtel said, it has so many different data points. Most of these are not accessible to investors. So of course you can do some kind of back testing, and you can take the whole data set and see if the expected loss and all of these terms line up, but fundamentally you kind of have to trust that they know what they're doing. And seeing as most of the portals have very significant work put into making the credit models, they've used all sorts of know-how from people who worked at banks doing the scoring models, then I don't see a reason to not trust them, because fundamentally, if a portal messes up their scoring model, they will not last very long, because the returns will not be what were expected, and the investors will just end up leaving. So it's kind of a matter of life and death for the portal as well to actually price the clients properly.
And what do you think about the MoneyZen's scoring module? Do you also trust MoneyZen with your money?
MoneyZen's scoring model is very zen, because there's not really all that much to track there. You just have to, in the end, the numbers are kind of made up. If they say that the client's credit rating is 763, then there's nothing you can really conclude from that, other than the fact that probably in some way they're better than someone who's at 800. So, I mean, it's kind of a take it or leave it. You can't invest in a portal and then not trust their credit model. So, since I've invested some money at MoneyZen, then I trust that they've done their job well.
Daniel, do you trust your scoring budget yourself?
Thank you, Kristi. I do, and my comment to the scoring model that traditionally it has been a bank model just to value if the person who takes a loan has an ability to repay it, and the banks have at this moment the largest data set available, but they still stick to traditional decision making. And now comes the new, let's say, new platform or peer-to-peer lender, and at this moment we have an opportunity to set ourselves the rules of setting or calculating a scoring model, and it is different in companies who provide alternative payment tools, peer-to-peer lenders, and everybody makes up their scoring model according to the strategy that they have. Now, what is more and more important besides the fact to evaluate the ability to repay is motivation to repay, because a lot of people see the new company in the market providing loans, and they just check it out. Maybe it's possible not to pay back the money. Maybe they just take it and not paying back. And to measure this motivation of a customer, this either takes time to how good is your scoring model, or you trust the data available on the market. And as for data, then I agree. Every day there are tons of data that you can acquire. But what also is important that you need some time, 1 year, 2 years, to find out the correlations. And if you come to the situation when you have found, okay, this is a correlation that matches my expectation, my strategy, I will use it, then you can be sure that during these 2 years, the situation has changed again. Which basically comes to the conclusion that everybody who is using scoring model are a bit more wrong with their calculation, because everything is changing. But the fact is that peer-to-peer lenders are pioneering in scoring, because they are developing more and more sophisticated scoring models.
Jevgenijs, Martins, do you trust the loan originators' data more, or do you have your own set of scoring model?
Yeah, I think that's a very easy question for me. Right? First of all, we don't work with independent loan originators. All loan originators belong to the same group. And do we trust our own scoring? Yes, we do. Every loan that is listed on Twino is pre-funded by us. So if investors decide not to invest in a particular loan, it's fine. We'll keep it on our own balance sheet because we run it through our own scoring models, and we believe that we can make money. The important question that Pärtel raised, right, is really how you build a scoring model. Right? I mean, yes, you can land 1 million, in a day, even in the smallest market, but will you get the money back? And you won't know it for a very long time, because you don't have the data to actually build the scoring models. So this is I believe why the players who've been in the business have a very strong advantage over the newcomers, right? And for us, even for us, right? You enter a new market, you account that you'll be losing money for half a year, before you learn how to actually score the customers in a very specific market. So scoring is the core component of this business, right? I would say it's pretty easy nowadays to build the investment part, right? There's just so much money around in the world chasing the returns. The hardest part is actually how to lend profitably, which rests on the scoring. And there's no kind of magic tricks about the scoring. It's about collecting the data, it's about analyzing it, it's about bringing people who understand how to interpret the data and improve the scoring model constantly.
Martins?
Yes, certainly we do. Just to take a step back, when we talk about peer-to-peer lending from the pure lending perspective, from the borrower's perspective, it's really like nothing new. the non-bank lending has been around for ages. The real innovation, which brings us back to one of the first questions, is on the investor's side. And through the P2P lending, it's just non-bank lenders get another source how they can fund the loans. If before they funded them through their own balance sheet, then now they can open up the marketplaces or come to the marketplace as Mintos and fund through the marketplace. So that gives a non-bank lender another source of the funding. From the borrower's perspective, believe me or not, the borrower doesn't really care. Is it money coming from investors? Is it coming from the bank line? Is it coming from the equity? The same 100 euros looks the same. Is it coming from any of those sources? So from the borrower's perspective, there's not that much innovation as we would like to think, because the non-bank lenders have been, many of those balance sheet lenders have been lending for a while, and that's also the case on our marketplace. Some of the loan originators say the last loan originator we connected is the largest non-bank mortgage lender in Latvia. They've been lending for 20 years. This is like combined, these platforms here presented do not have probably that much experience in lending. And obviously,
We don't have the experience lending in Latvian mortgage loans. Combined experience is bigger.
I mean, on the year, on the basically time span. But what I'm trying to say is that continuing the discussion, the models evolve through lending. So you have to lend actually to build your models. You cannot just come and build a model without actually lending the money. So this track record and experience is very crucial, and that's how we look at the loan originators. When we allow them to connect to our marketplace, is their track record.
Kristi, to agree with Martin's here that, I would like to ask whether you should you trust the scoring models, and you would like to see a scoring model on a portal, or you would like to trust the loan originators with choice, like in Mintos.
I mean, in the end, it doesn't really matter if the portal itself is the originator or they have other originators who they're listing on the marketplace, because, I mean, fundamentally the business of lending works the same. You need to get as much data about the client, filter out what's useful, and then take advantage of it. So I think just in a couple of years, I believe that the models provided through peer-to-peer lending might actually start pulling ahead a bit due to just the impact of big data and how it's being used. But overall, as an investor, once again, if you've decided to trust them, then the same way you cannot check the model of what MoneyZen or Bondora is using, you can't really check all the individual models of the originators listed on Mintos either. You just have to believe that they're doing their job well, if they've done it well so far.
And just to add, like, we've seen a lot of loan originators and a lot of models. Some of the non-bank lenders, which are balance sheet lenders, they have way more sophisticated credit models than peer-to-peer lenders. And they built it through balance sheet. And again, this is a track record. They've been lending for years and years, and they have tested their models also through the recessions, some of them.
So, as I promised, to take a couple of questions before the break from the audience. This question is for you, Pärtel. My portfolio is 100% in Estonian loans, about 30% interest on them, but 1/3 is still in default. No actions with defaulted loans within a year. Is that normal?
Depends where you invest specifically. The anonymous person can sort of hook up later on during the coffee break. It depends, right? So it depends what risk level, what sort of service you're buying. Just mathematically, to answer the question, if you have 36% average interest rate and 1/3 is defaulted, and assuming that this is a mature portfolio, sort of like a year away, because otherwise you can't say nothing has happened in a year, and that makes that equates to roughly, it's probably around 30 or 20+% net return on the portfolio. And one of the things, just to sort of to clarify around, I think there was another question about our return calculation as well. Whenever you look at the returns, the calculation isn't interest rate minus defaults or something like that. the whole concept needs to be looked at somewhat more thoroughly, and that's why we built the cash flow, or this your own return simulator on Bondora. So if you don't like or trust the way Bondora calculates the returns and has done for the last 5 years, then you can use your own models. Because whatever you're doing, you're always doing predicting the future. And whatever model you do for predicting the future, regardless of the credit scoring model or other models, it's going to be wrong because we don't know what's the future. So in terms of to answer that question specifically, we can look into your portfolio during the coffee break. In general, it really depends where you invest, right? If you invest across the board, or if you're investing in higher risk loans or lower risk loans, or how much you've invested. There's a couple of cases we've seen where investors join up with 500 euros and they make 3 investments, right? And then statistically, even if you invest the lowest risk loans, like, if you invest in 3 loans, then you can have 33% or 66% defaults, even at the lowest sort of segment level. So, in general, it's not normal in Bondora, but it really depends how you invest in. So the main thing is if you kickstart, we'd recommend you to start either passively, meaning that the system starts investing across Bondora in 5 euro pieces until it reaches 200 loans, and then it goes to 10 euro pieces. And the last thing, what we sort of recommend or don't recommend at all, is very active selection of loans, and we put a lot of money into actively selected loans based on some analysis, because typically the investors who've done very active portfolio management have lost more money or actually have made less money than the ones who are using passive portfolios, because their analysis has sort of misfired a bit or this and that. So in terms of the recovery, there's a recovery question there as well. As far as I know, all Estonian loans are pushed to court, as we speak. The same in Spain and Estonia. For the customers who've been with us for some time know that last summer we kickstarted a setup where we used debt collection agencies before we pushed cases to court. So within this last year or so, there's been processing with the debt collection agencies, and now if nothing was recovered or there was no recovery performance from the debt collectors, we're pushing these to court. In the future, that's going to be faster again.
So as you told before, mathematics, so this person would, with mature portfolio, would earn 20% of interest?
Yeah, so just very, on average, your portfolio is probably 4 or 5 years in maturity, right? So, and if you have 40, let's say you don't recover a single cent, so you have 0.7% or 70% of your portfolio, roughly making 36% a year, which is 36% and 70% is 22 something times 5 equals. So anyway, short term is that you have to, if you lose like a third of your portfolio, let's say, or 20% of your portfolio, that means the rest of the portfolio is going to make their average interest over the next lifespan, right? So your returns aren't after 1 year. So lending happens the following way, you, like, in order to compensate for the losses, the rest of the portfolio needs to earn enough interest to compensate for this segment, right? And it depends on the life cycle of the loan. Typically for 4 or 5 years of loans, the loss curve ends up after 12 months. So if you look at we've done more analysis on the performance of the portfolios, you take the biggest losses in the first months, so you see the biggest jump. Then during the first 6 months, as the loss continues to increase, then at around month 12, it stabilizes and keeps stable or goes up. If you count in the recoveries, you'll see the losses coming down. What typically happens is that investors look at the portfolios after maybe 6 months to 12 months, and then project the same curve for the rest of the portfolio and get scared. And then they go off and sell their portfolios on the secondary market with a huge discount for others to sort of pick it up, and effective through that they will further extrapolate the losses. So in short, let's have a look at your portfolio. But when you're investing on Bondora and you're investing in higher risk segment loans, then this segment is profitable when you invest, for the term. And when you don't invest into if it's 1 year, then the performing part of the portfolio does not compensate for the losses made. The performing part of the portfolio needs to mature in order to compensate for the losses made in the first 6 months to 12 months. If you invest in the higher grade or low risk segments, then the situation is different. It's going to be flat out and stable. So if you're less risk averse or if you're looking at very short term, then always rather go to low risk segments than high risk segments. If you're in for the long term and you only care about the end result after the 5 years, then the high risk segments, depending on tax situation, typically play out much better than the lower risk segments.
And then the second most popular question there was really fast answers on this one. Are you planning a way to increase the liquidity of a peer-to-peer lending solution? So it means to sell part or whole portfolio without dealing one or two loans or loans separately. So maybe Daniel would answer. Are you planning to make secondary market?
Yes, definitely.
Yes, very good fast answers. And Pärtel?
We already have a secondary market. Since Friday, you can sell all your loans in one go. They're still going to be listed as individual loans, but you can sell them in one click of a button. And over the coming months, we're further going to make investment on secondary market and buying loans from the secondary market a faster process.
Jevgenijs, what secondary market?
Yeah, for us, secondary market is not a way to kind of gain extra return, markups or something. For us, it's a purely a way for investors to have liquidity to their portfolios. They change the investment strategy, decide to start investing more in Polish loans, they can sell the Georgian or Danish loans on the secondary market. And so far, this strategy has been paying off, right? So we have, I don't know the numbers for the other players, but for us, the secondary market is pretty liquid. So last month, there was about €4.5 million invested on the primary market, and on top of that, 700,000 went through the secondary market. So a pretty large proportion is done through the secondary market, and so far we believe that we match the liquidity of investors.
Martins?
Yeah, we run the secondary market from the very beginning. It's the same for investors who seek liquidity to get liquidity. It's very liquid actually in general.
And the whole portfolio selling?
You can sell it at one click, sell whole portfolio, but again it depends on the demand side, if there's going to be demand for this portfolio. So whenever investors invest in general, they should expect to hold the loan till maturity. Of course, you can put it on the secondary market, but there's no guarantees that there's going to be demand for that.
So thank you for the first part. We're going to have a quick stretch and coffee break, and in 10 minutes we'll do a really quick second part, which is going to be about investor sides. So many investors here, Kristi is here, so we're going to ask a lot of questions about investors. So let's be back here in under 10 minutes. This poll is still on the screen here, so we can see 31 people have answered the question. 74% of this 31 people have invested in Bondora, 34% in Mintos, 16% haven't invested yet, 13% in Twino, and MoneyZen is 9% right now. So you can see how this crowd kind of goes into sectors and how much market cap you have in terms of investors. But let's go on with the investor round, and I will get to the questions. I think the first interesting question is that which portals do you invest on yourself? Is it only the one that you're working at, or do you invest in others as well? Let's give it to Daniel.
I'm investing mostly in MoneyZen, but I have also investments in 3 other peer-to-peer lending portals, 1 in Estonia and 2 in Finland.
Jevgenijs.
Twino and logical.
And actually, there's a question from the audience about this as well, but that's on the screen right now. So, how much have you invested in peer-to-peer? So, let's count some money too, if you want to disclose, or maybe just a percentage of your portfolio.
My exposure is over 100,000 euros at the moment.
Jevgenijs.
Yeah, slightly less than 10, almost 10.
Kristi, you as well.
Since I don't have my own portal, then I invest across the board. So the core of my portfolio is made up of 5 different portals, and then I've tested out most of the others that we have access in Estonia, and about a third of my total portfolio is in peer-to-peer loans.
Pärtel.
I invest only in Bondora, and I have around 7,000 euros.
I actually invest across many different platforms, because when we launched the platform, we did a quite in-depth research. So my experience runs from the US, from the UK, even South Africa, Germany, and the Baltics, obviously. And that's also in some of those countries where I cannot get access, I get it through my friends. So my invested amount has to be split somewhere with my friends as well.
Hope this answered the question. Maybe another question on top of that would be, who should not invest in your portal and in crowdfunding, peer-to-peer lending? Then
This is a question we had yesterday as well, and I can use the same approach. The easiest way to answer that is that people who do not comply with money laundering should not invest. They must not invest. But otherwise, the other version of a question is also, I like to keep it simple. The people who do not understand what they are doing shouldn't invest in peer-to-peer lending. This is very simple said.
Jevgenijs.
I mean, it's still an investment, right? It's not a deposit guaranteed by the state, right? So, I mean, probably if that's the only money you have to invest, you shouldn't put it all into peer-to-peer lending.
Kristi.
I'm going to say the same thing I did yesterday, that the people whose nerves cannot handle the pressure should probably not invest it. I've come across several investors who have invested money, and then when loans have defaulted, they have gotten very angry that someone has taken their money and then gone away somewhere and done something with it. So you have to be able to sleep at night, and if you get upset over the fact that money defaults and so it runs off somewhere, then peer-to-peer investing is probably not for you.
I think Pärtel said the same thing, that people go out too early, put all their loans to secondary market, and then don't wait for the return and the maturity of the portfolio. Who shouldn't invest in Bondora?
I don't think Bondora is anyhow different than other platforms in the sense of if you can't afford to lose the money you're investing, do not invest, like period, whatever it is into. Lending Club stock that was also very sort of stable, lost 75 million, a big chunk of the value in one day. Stuff happens with all investments. So, if you're only invest the money that you can sleep losing. It doesn't mean that you have to lose it or it's going to actually go that way, but you have to be sound. So if the €5 loan defaulting, puts you in a bizarre, don't do it. From more technical perspective, in order to diversify, we'd recommend that you have like a plan to within the 3 to 6, maximum to 12-month period, really to build up the portfolio to a roughly €1,000 loan. Because otherwise you simply won't have enough loans in the portfolio to diversify enough. Effectively, these things set the limit. I think the bigger thing is about you have to be able to or willing to lose this money to to start investing in something new, something that you haven't had experience with before?
Martin.
Yeah, as the last one, it's tough to add anything new, but it's probably the same that was already discussed as those who are putting the whole investment capital they have should invest like the whole investment capital in the peer-to-peer lending should be a diversified approach, and with the peer-to-peer lending being just one asset class.
How does the median investor look like in Mintos?
The median investor will have invested around 3,500 euros across many different loans. The average investment probably is 30 euros per loan, which gives a good diversification of something like, on average, probably 100 loans per investor. The demographics-wise, that would be it's going to differ actually by geography a lot.
It's going to be Estonian?
Estonian, we are very happy to have almost 2,000 Estonian investors on our marketplace, so it's a decent chunk of all the investors. In total, we have 7,000 investors. Just to give perspective, from the Baltics, we're going to see more younger, basically people, and from the Western Europe, there's going to be more older people.
Pärtel. What does the median investor look like?
Our big portfolio proportion of the investors come from Estonia, Germany, UK, Switzerland. The median investor, or the investors that make up roughly 80% of the capital deployed, have deposited or have invested on average 6,000 euros. Once again, typically, in our region, people who are investing online and have capital to invest are, a bit younger. From UK, Germany, I think the sort of a bit more seasoned investors. Typical profile of an investor that matches this sort of segment is a professional with either entrepreneurship, financials, investing, banking, or sort of management level background. So people with economic backgrounds. We have a lot of retail investors who are, very early on starting in investing. But most of the investors on Bondora consider themselves to be, not slightly above average, but considerably above average in investing. And I think when you reflect back to the previous sort of question, then I think that's sort of the entry level. If you're starting out today with investing, then put your money into an ETF. Just don't look at it for 12, 18 months. Get used to this and just build up from there.
Jevgenijs.
Yeah, so historically we obviously had a lot of investors from Latvia, but if you look at the kind of recent months of who's adding money to their accounts or who's investing on the platform, this would be investors from Germany, UK, Estonia, quite high on the list, and Netherlands. Right? If you think of it, it's pretty logical, right? We're one of the kind of newcomers to the place, so primarily or at least our largest investors are investors who've been investing on other platforms, and this is why they come from Germany with the Ox money, they come from the UK where they have Zopa rates there, and they come from Estonia where you have Bondora. So these are usually investors who understand what is P2P, how it works. So they come and ask a very specific question of what flavor of P2P we have on Twino.
Daniel.
Mostly MoneyZen users are experienced in P2P, and they are private persons usually investing either privately or using their own companies. Average portfolio is between 4,000 and 5,000 euros.
So, Kristi, this hypothetical question about if someone gives you a bunch of money, let's say 10,000 euros, right now we have 4 lending sites here, how would you allocate this 10,000 euros? It's not the disclaimer, no investment advice is
this money is theoretical, so don't follow what I'm saying. I'd probably say that you should choose, if 10,000 is the amount, then you should probably choose 2 or 3 portals to diversify in between, and you should just pick between categories. You have short-term loans, long-term loans, and then you can pretty much take your pick between the countries, essentially.
So which would you leave out right now?
I would leave out MoneyZen because they don't have their permission to give out loans. So,
That's an easy one.
so
But
that's the easy one.
if you were about to choose 2 of them,
for the sake of friendship of nations, then one of them would be Latvian and one of them would be Estonian.
You boys fight it out.
so you kind of know what question is next. So which Latvian is gonna?
Which Latvians the most important?
So I'll have to think on that a bit.
Okay, we're gonna grade the poll after the show, and we can decide it. Okay, but what are the most important criteria? What you're looking for?
Well, at this point, I'm trying to diversify across different portfolios, different portals, and what I want is, firstly, as we talked, trust, but secondly, deal flow and return. And what is also now possible, that wasn't possible before, is to actually pick and choose between the loan length as well, because people like taking loans for a very long period because they don't really want to have a very high monthly payment. So with Estonian sites, Omaha and Bondora, then most people tend to take out very long loans, 5 years or so. What you can...
Reduce levels the fee. We have
No, 3 years. So still, if you take in the recovery, then it's still a 5-year period. So now you can actually choose between shorter term loans as well, which gives you probably some confidence in the liquidity that with Twino that you can get out most of your money in a matter of months from the loans that have not been extended. And with Mintos, the same thing, that on the same portal, you can choose long-term, car loans that run up to something like 7-8 years, and you can also take short-term, like banknote loans, that's just a couple of months. So I think variety is what I'm looking for right now.
About investors, so there's 2 kinds of investors. One is retail investor, other one is institutional investor. How many do you have on your site? Institutional investors, what's the percentage? And would you like to lure more into your portal?
MoneyZen doesn't have any institutional investors, and it is, say, when we have sufficient volumes and the business flow, then we can build it up that side as well. But at the moment, this is 0.
Jevgenijs.
Yeah, we 100% retail for the obvious reason. I mean, as a group, we originate about 15 million euro per month. I think for any reasonable institutional investor, you would need to kind of provide 5 to 10 million per month. So we believe just that even a single institutional investor would just distort the market, and we don't think we're ready in terms of the volumes on the lending side.
Pärtel.
We have a couple that has joined up since last year. In general, today, for institutional investors to go into marketplace lending, it's probably the worst time in the last 5 years. If you have followed the news, then it's a pretty bad time for institutional investors because they gotten scared awake of the recent changes. So what you're seeing is that more platforms, including Lending Club in the US and Prosper, that have spread-headed the institutionalization of the product, are putting a lot more focus on the retail investors. On our side, I mean, the investors we have today are sort of mid-sized institutions, so family offices, with perspective of having portfolios between 1 to 2 million on Bondora. We're today, as I mentioned, like 2016 is going to be our sort of kickstart to the investor product here. And today we have different plans for the different segments of the market. So we're attracting larger institutions, but we have a lot of different activities there to also sort of bring in retail investors and sort of the high net worth individuals in between.
Mortgage.
We actually have a few institutional investors, but split is something 90-95% is retail, and we are pretty much building the marketplace based on the retail investors. And for a few reasons, I think the US experience of the last year or a bit less have shown the basically negative sides of the institutional investors. It's sort of easier to build up the scale, but it's also much easier to lose the scale. So retail is more sticky in general. And the other reason is because loan originators which use our marketplace, they fund part of the loans still through the balance sheet, and they're gonna fund through part of it through the marketplace. So some of them have institutional money through the balance sheet. So for instance, Mongo, they have a fund which is investing directly through the balance sheet. So the need for another institutional money through the marketplace a bit disappears.
So what investors seek return? So really quick answers from you. What's the average return that the investor could get with a mature portfolio? Martins.
Average for us is 12.5%, but it's going to differ from the loan originator, from the investor to investor. So we have 5 different loan products: invoice financing, unsecured personal loans, mortgage loans, secured car loans, and business loans. And there's whenever you look at the risk and the return, you also have to look at the risk. So some investors are gonna rather invest in a lower yielding mortgage loans for a longer term, but they cannot expose themselves to lower risk. So the average is 12.5.
Pärtel.
12 to 18%, depending on your strategy, and depending on also sort of your term preference.
Jevgenijs.
Yeah, so we, in our case, interest rate is essentially the return because we provide the buyback guarantee, and the current rate is different from 10% to 13%. So it mostly depends on the kind of the horizon of your investment regards, and the average is about 13.
Daniel.
We are stating that the return rate is not less than 12%, but on average this is 15 to 16, and in some cases it's close to 20.
Kristi, have you seen these returns in your portfolio?
Yes, they do exist in the actual wilderness. But as said, it depends from investor to investor, because I started with Bondora a long time ago, then I got to enjoy the benefits of completely unpriced loans, where very good customers were given loans with super high interest rates. So a lot of the returns that were achieved in Bondora back then are not really doable at this point anymore.
Did it spoil the market a little bit?
I think, well, of course,
Yes.
if you were in the top tier of money earned, then of course it was terrible that they fixed the pricing. But for the average investor, it's of course better, because now you actually, when you look at the rating, it actually tells you something. Before, when you looked at the rating, it said that it's a rating and there was nothing behind it actually.
So we have exactly that time left that we could take the questions from the screen. Let's start with the regulationary side. Any of you going to release a feature, bring a friend, which would take off the legal requirements of verifying a customer?
You can, if you know your friends some details, you could invest in your friend's loan for our API if you buy the whole loan. So that's doable, depending if your friend actually passes through our credit checks. So that's a bigger question you have to ask.
So that's a workaround. It's a hack. Martins.
Not really, haven't thought of that. I guess we have loan originators in 6 different countries, so you have to have a lot of friends. Friend you want to loan to.
Jevgenijs.
No, really, I don't think there's a big market for that.
But in terms of investor side, so if your friend brings a friend who's going to invest,
Oh, we are actually launching tomorrow a refer a friend program. So yeah, you can bring a friend. You're gonna benefit both of you.
Can I bring the whole cloud? That is good. But Daniel, what about you?
We don't plan to have it, but at the same time, I can comment that quite a lot of investors have been coming in with suggestion or referral from another investors, and we also have some borrowers who have applied for a loan because somebody earlier, some acquaintance or a friend has taken a loan from MoneyZen.
So let's also look into the pockets of companies here. So are you making money right now, this running year?
Because of this is unfair question because because at this moment it's quite interesting situation for MoneyZen. We haven't got the license from regulator, and therefore our actions are limited, and we do not have any marketing. So the honest answer is yes, we are making the money, but this is actually the bad thing because we do not generate any new business. So basically we are losing from both ends.
Thanks for the honest answer, Jevgenijs.
Yeah, we're profitable and we've been profitable for over 3 years now.
You launched last year, no?
So I mean, for us, you know, as our kind of industry colleagues confirmed, it's a mechanism, right? So we look the platform, right? So we look at Twino as a group, right? We don't make money on the platform, right? We make money on keeping the spread in the interest rate between what borrower pays and what we pay to the investors, similar to rate setter, Vaba, and so on. So this is why we look at it as combined, and combined we've been profitable.
But Twino is
Twino is a subsidiary of Amanda.
So Pärtel, the same question.
We're not profitable today, but by Q4 this year, we intend to go into the black.
Martin.
Yeah, for us is actually question has to be split in two. First, Mintos as a technology or marketplace, we actually just published our annual report on our website, so feel free to look at it. 2015, it wasn't profitable, as you might expect, because we are a new marketplace and we are really focusing on the growth. The other part of the question, which I think is for investors in many cases much more important, is the profitability of the loan originators. And we also publish the financial statements of the loan originators, and many of them are very profitable. Take Banknote, for instance, they've been around for a number of years, and last year they did almost 1.5 million in profits, net profits, so which is in many cases much better result than even the big guys in the UK, but that's not a fair comparison because you always have to choose between the growth and the profitability. So.
Yeah, and just like a comment to Pärtel's question. So, no, I mean what we're doing now is essentially we initiated the process of merging Twino and the parent company. So Twino will essentially become the group, right? So Twino will own all the lenders that originate the loans locally, right? So Twino will have the consolidated assets of the group. So the question would be the same as, you know, if you were invested department profitable or not, or is your borrower department? We see it as a group, right? We're a lender. This is the main business, and Twino as a platform is just part of the bigger picture.
But as like us, you're not profitable. Until you get married.
Where could one find the financial year report about your financial year, just for the investor's sake?
On our website, Investor Relations, download financial report 2015, and then for each of the loan originators, as we get the reports, we publish them on a separate section under the loan originators.
Pärtel.
2015 results, soon to be finished auditing, will be available on the website.
It's in the website, so this week we'll publish the latest.
Daniel.
We don't have a plan to publish that on website, so it can be changed, but at this moment it's not available, and we don't have a plan to put it up.
Thank you for those. I'm going to take the last question. There's actually 3 questions only left, and I'm going to take the highest ranking one. What do you think are the future prospects of peer-to-peer lending markets, and where is the market heading? Where are you heading as a company? I would actually like to ask Kristi the first part. What do you think is the future prospect of peer-to-peer lending?
I think the future prospect is that it will be much more mainstream as an investment than it is right now. But I think to become more mainstream, the product will probably have to simplify a bit to bring in more investors.
Others, a free mic.
The market, the B2B lending market in general, as mentioned, is going to sort of streamlined into typical investment products, but that will also come with a disadvantage for many early starters. That will mean the end of the website investing. Investors will see B2B or marketplace debt or assets or equity in their loan portfolios or investment portfolios that we've seen already in the UK and US. And that's on the good positive side, so more people will buy in. On the negative side, the recession that's slowly starting will wipe out more of the platforms. Bigger part in UK, but I think in across Europe there's going to be somewhat of a cold winter, especially from very early starting companies that have sort of like recently kicked off and don't have like a stable balance, because they're springing up very, very rapidly, not in the Baltic area, but especially in the UK, US, and that's going to sort of hurt. And I think it's in general, the fintech sector in general will have a cold winter coming soon.
Others?
Yeah, as we've discussed today, right? So peer-to-peer lenders have 2 amazing benefits. One, we're as efficient as non-bank lenders, and we have a capital that is way more flexible than what balance sheet lenders have. So I think it's kind of fundamental basis to create a change across Europe, because so far there has nothing been done across continental Europe. You see only 2 players that reached any significant volumes, and even those volumes are tiny compared to banks. So I think there is just like huge potential. But I don't think it's a perspective of 3 to 5 years. I think there is 20, 30, 50 years of work to be done to actually kind of become a reasonable force in the lending space in continental Europe.
I guess when you look in the future, there's sayings that people tend to overestimate what's going to change in 2 years and underestimate what's going to change in 10 years. So I think in 10 years is that we can see actually a lot of change in general how we look at the loan, and especially what we also already discussed before is that in general the peer-to-peer lending, the innovation is really on the funding side, on investors getting access to the asset class which previously was not available. And what it brings, the benefits, is that there's a much more efficient financial capital market, and at the end of the day the positive sides, the positive of that is felt by both sides, by investors who get a better return and by the borrowers who get a better priced loan. And that's probably what we're going to see, that the loan just becomes much more sort of tradable than it is now.
Tony?
I agree actually that there is definitely to be more mainstream product and definitely going to grow, and we cannot see in what form or what shape peer-to-peer lending will be in 5 or 10 years. But also the good side is there is a huge potential there, and this is not only for the taking the prime customers from banks. It is also based on the technological innovation which started basically the peer-to-peer lending 10 years ago. So the not so good news is that the bigger the peer-to-peer lending is, the more pressure will come from regulators, and this will affect the users of peer-to-peer lending platforms.
So the last question, one word answer. It's going to be for me that if you would catch a cold fish, but it's a little bit, it doesn't want to give you 3 wishes, it gives you 1 wish. What would be the thing that you want to change in peer-to-peer lending or on your site? As like this, Martins.
One wish would be that all the 700 million inhabitants of Europe knows what's peer-to-peer lending with a click.
Pärtel.
On a practical thought, I would like to have a level competitive field in Europe, both between the marketplaces and banks. So a single regulatory model would help out here.
Kristi.
From the investor side, actually fixing the current tax issues, so allowing you to invest into peer-to-peer loans through your investment account and hopefully through your pension funds as well.
Jevgenijs.
More open Europe, meaning that the P2P lenders can answer some of the markets that are restricted to banks only.
Daniel.
The first answer would be to follow Martins, but say, okay, let's make it 7 billion all around the world to know what it is. But if it would be about the MoneyZen, then it's easy. It's give me the license.
As my funds are also in MoneyZen, I hope the same thing. Switch. But that's all for today. I think our panelists deserve a huge applause, and we're going to do it a little bit differently. So a really quiet applause is down here, and when I raise my hand, we're going to go really loud. So let's see how long we can get. So applause. So people like you guys came from Latvia, you made time to come here today and yesterday, some of you. So we have something to give you also. We're gonna give no Latvians had time to come here. You made time to come here. I thank all of you and the people that also. So also like all of you. I mean, I'm gonna give you a hug, all of you too. So first, Jevgenijs, would you step up here? A huge thank you. So in here, there's 3 sets of things. First, we got the pin, and no one has the pin on them, but it's an investment club pin, and it's golden, so very good honor. Also, for health's sake, there's tea, some homemade honey, and some chocolates. And the most important thing I want to give you is the honorary membership status. So you're free to welcome any of our events for free. So thank you so much. Martins. Same things in the back here. So huge thank you that you made time to come here.
Right.
Thank you so much. So, Pärtel, I'd like to thank you that you made time to come here. Yeah. So, the same thing, the pin, I see you have a place here where to put it. It's in the golden box, and also you're our honorary member right now, so feel free to come to our events.
Charge for the night.
No, we're not going to charge.
Thank you.
The house was enough. So, Daniel, would you come here? So, huge round of applause. Welcome to the honorary members of the Investment Club. And last but not least, Kristi. Thank you. Still, we made it. We went overtime by 7 minutes, so thank you for hanging in there. Next event is going to happen in two weeks. It's going to be about real estate. We got Pärtel from Estonia for the event, but stay tuned in our Facebook page, on our homepage. And for today, have a nice night, sleep well, don't let the bed bugs bite. Yeah, that's it. Thank you so much.